So you've heard that a Roth IRA is one of the best ways to grow your wealth completely tax-free. But here's something crucial. Simply opening a Roth IRA isn't enough. A common mistake people make is thinking that just contributing money means they've invested. That's not the case. Once you deposit money into your Roth IRA, you need to take the next step. You have to actually invest it. If you don't, your money is just sitting there, not working for you. Imagine your Roth IRA as a fertile garden. It has rich, nutrient-packed soil where anything you plant can grow tax-free. But here's the thing. You have to plant something. If you don't, nothing will ever grow. And it's not just about planting any seeds. You need the right combination. Otherwise, you risk making the wrong choices and missing out on the chance to build a thriving, abundant financial future. One that continues to generate passive income long after you've stopped working. That's why in this video, we're diving into the 5 best investments for your Roth IRA, starting with the S&P 500 Index Fund. Think of this as the foundation of your investment garden. The strong, towering trees that provide stability and long-term growth. The S&P 500 Index represents the 500 biggest companies in the U.S., including giants like Apple, Microsoft, and Google. What makes this investment so powerful? Consistency and reliability. Over the past century, the S&P 500 has delivered an average return of 8% to 10% per year. To put that into perspective, if you had invested $10,000 in an S&P 500 index fund 50 years ago, today that investment would be worth nearly $2.2 million. That's why the S&P 500 index fund is a cornerstone of any smart investment strategy. Another huge advantage? Low fees. Unlike actively managed funds, which require professional managers to handpick stocks and charge high fees for it, an S&P 500 index fund automatically tracks the index, which is why it's called an index fund. That means lower costs for you. In fact, these funds typically have expense ratios under 0.1%, a tiny fraction compared to actively managed funds, which can charge 1% to 2% in fees. Over time, those high fees can eat away at your profits, potentially costing you over $100,000 in lost returns. That's why it's smart to stick with low-cost index funds whenever possible, and an S&P 500 index fund is the perfect place to start. Some of the most popular choices include VOO, Vanguard's S&P 500 ETF, with an ultra-low 0.03% expense ratio, VFIAX, Vanguard's S&P 500 Mutual Fund, for those who prefer mutual funds over ETFs. If you want to learn more about the difference between ETFs and mutual funds, check out this other video right here. Once you've planted your S&P 500 index fund in your Roth IRA, just leave it alone and let it grow. These investments are built to weather the ups and downs of the market. As long as you stay patient and let time do its thing, you'll see your wealth grow stronger year after year. So we just talked about the S&P 500 index fund, which tracks the 500 largest companies in the US. But what about all the other companies in the country? The ones that aren't big enough to make it into the S&P 500? For example, we have companies like Shake Shack, Bed Bath & Beyond, Crocs, and Williams-Sonoma. These are what we call small-cap and mid-cap companies. The S&P 500 only includes large-cap companies. Generally, when you combine large-cap, small-cap, and mid-cap companies, you get what's called a total stock market index fund. Smaller companies tend to grow faster, which means your returns could potentially be much higher compared to investing only in the S&P 500. Over the past 50 years, small-cap stocks have had an average return of 11.4%, while large-cap stocks have returned 10.7%. This means that a $10,000 investment in large-cap stocks would have grown to $2.2 million, whereas the same $10,000 invested in small-cap stocks would have grown to $3.1 million. Think of it like comparing a newborn baby to a teenager. A teenager is almost fully grown, while a newborn still has a long way to go. In this analogy, small-cap companies are like newborns. They have massive growth potential. Meanwhile, large-cap companies, since they've already grown so much, experience more limited returns and growth. That said, you actually want both in your portfolio. Large-cap companies may not grow as fast, but they tend to be more stable. Small-cap companies, on the other hand, will drive higher returns, but they can be more volatile. That's why a total stock market index fund, which includes all small, mid, and large-cap companies, is the most diversified approach. Just like with the S&P 500, you want to choose low-cost index funds when looking for a total stock market index fund. Some great options to consider are VTI and VTSAX. One thing to keep in mind, if you already own a total stock market index fund in your Roth IRA, you don't need an S&P 500 index fund. That would be redundant since the total stock market index fund already includes the S&P 500 stocks. So choose one or the other. Now, if you want a complete list of all the best index funds, including all the funds we'll talk about in this video, you'll love my index fund cheat sheet. I've already done the work of finding the best index funds for you, complete with clickable links and descriptions. Having everything in one place will make your investing journey so much easier. The link is below, or just scan this QR code to download it. Alright, so we've covered the US market. But did you know that the US stock market only makes up about 60% of the global stock market? What about the remaining 40%? That's where international stock funds come in. The reason you want to include international funds in your Roth IRA portfolio is that there are times when international markets outperform the US stock market. Now, it's true that over the past decade, the US stock market has been the best performing market by far. It's been the shining star. But that hasn't always been the case, and you can't expect it to always be that way in the future. For example, from 2000 to 2009, the US stock market actually underperformed significantly. The S&P 500 returned negative 9.1%, while developed international markets saw returns of 17.7%. And emerging markets, countries like Russia, China, and Brazil, which some might refer to as third world countries, saw an incredible return of 154% during that time. So, while you definitely want stable evergreens, like the US stock market, growing in your investment garden, you also want to diversify with other types of plants, like international stock funds. Geographic diversification is key. If you only hold US stocks, there will be times when you actually lose money, while investors who diversified into international stocks will be making money during those same periods. The way to include international stocks in your Roth IRA portfolio is to add an international index fund, such as VEA, Vanguard's ETF for developed countries outside the US, VWO, Vanguard's index fund for emerging markets. Or if you want one single fund that invests in all international companies, whether they're in developed nations or emerging markets, you can look into a fund like VXUS. Once again, I've included all of these in my index fund cheat sheet, so feel free to check it out. It breaks everything down for you. Alright, and now, the next part of your garden for diversification. We're going to add some shrubs, some trees, what are these? Some bushes, whatever you want to call them. I'm talking about bonds, and they're a fantastic addition to your portfolio because they complement stocks so well. Like if stocks are your peanut butter, bonds are your jelly, and together they make the ultimate combination. Actually, that's a really dumb analogy. The real reason bonds complement stocks so well is that they typically react in the exact opposite way to stocks in different economic situations. For example, when the economy is growing a lot, bonds tend to move slowly upward, while stocks are doing really well. Then, when the economy isn't doing great, like during a recession, bonds actually perform really well while stocks take a hit. So, while bonds might not seem exciting to own, especially when the economy is booming and you wish you'd put all your money into stocks, you should know that when those tough times come, you'll be really glad that at least a portion of your portfolio isn't suffering and is actually thriving, even while everything else is losing money. For example, during the 2008 financial crisis, If you had a 100% stock portfolio at the worst point of the market crash, your portfolio would have dropped by up to 50%. Meanwhile, if you had a portfolio with 50% stocks and 50% bonds, your portfolio would have only dropped 25%. That's a lot easier to stomach than a 50% drop. Now, if you're a younger person, if you have, say, 20 to 30 years before you actually need to retire and live off that money, then a 50% drop isn't a big deal because you can just wait for the recovery. But if you're older and retirement is just a year or two or even 5 years away, then a 50% drop in your portfolio means it'll take much longer to recover those losses, and that will negatively impact your retirement. That's why, the older you get, the more you want to invest in bonds. The reason bonds are much more stable than stocks is that bonds are a form of lending money, while stocks are a form of ownership. When you own part of a company, you get all the benefits, but also take on all the risks. But if you're just lending money to a company, like when you invest in bonds, you're simply collecting interest payments and eventually getting your original principal back. And even if the company does really, really well, you only get your fixed interest and principal. On the other hand, if the company does really poorly, logically, because bonds are a legal obligation, your money is actually pretty well protected. So, if you want to add bonds to your Roth IRA portfolio, a few great options to consider are BND. This is Vanguard's Total Bond Market ETF. FUAMX. This is Fidelity's Intermediate Treasury Index Fund. And once again, for a breakdown of all these different index funds, and many more, don't forget to check out my index fund cheat sheet. And now, the fifth investment to add to your garden, REITs. REITs stand for Real Estate Investment Trusts, and basically they're stocks of huge companies that own real estate portfolios. What I love about REITs is that they let you become a real estate investor without needing tens or even hundreds of thousands of dollars for a down payment on a property. Because instead of buying real estate directly, you can just buy shares of a company that owns tons of real estate. And essentially, that's the same thing as owning real estate yourself. REITs are legally required not only to invest in massive real estate portfolios, but also to pay out 90% of their rental income profits to you, as an investor, in the form of dividends. So REITs are actually a fantastic form of passive income, where you can earn rental income without the hassle of being a landlord, or putting up a ton of capital. However, one thing to watch out for with REITs is the importance of diversifying your investments across different sectors. REITs often focus on specific real estate sectors, such as residential real estate, commercial real estate, healthcare real estate, or even industrial real estate, self-storage facilities, and more. So, for example, if there's a major decline in the retail and in-person shopping sector, REITs that own a lot of shopping malls will take a big hit. To solve this problem, you can invest in REITs that diversify across multiple real estate sectors. One example of a diversified REIT fund is VNQ. This is Vanguard's REIT Index Fund, which includes commercial, industrial, and residential properties. Now, when looking at REITs, another key thing to consider is dividend yield. Dividend yield is the amount of money you receive in dividends per share each year, divided by the share price. The idea behind dividend yield is that if it's really high, you're getting more money for your investment, because at a lower stock price, you're getting more dividends in proportion. In other words, high dividend yield. Good low dividend yield. Bad. However, there's a catch, because sometimes something can be too good to be true. When dividend yields seem way too high, that's something to investigate further. For example, let's say that at a time when most REITs are paying a 3% to 6% dividend yield, NYMT is paying double that, 13%. Now, that sounds amazing, but it's actually a red flag, because it means the stock price is way too low. And if the stock price is too low while they're paying out massive dividends, that means your original investment could actually be at risk. NYMT is an example of a REIT that might look good if you only focus on its dividend yield. But if you check its history, you'll see that it never really recovered from the 2008 financial crisis, and its stock has been on a steady decline ever since. So, don't be fooled by high dividend yields when picking your REITs. Also, FYI, every single investment we're talking about in this video pays dividends. It's just that REITs tend to pay a little more because by law, they must distribute 90% of their income as dividends. So, those are the 5 key elements of a Roth IRA garden, or really of a well-diversified portfolio. That being said, if you don't want to go through the hassle of picking all these investments yourself, I have a bonus option for you. You can buy a target date fund. Buying a target date fund is like buying a pre-made garden. It already comes with all of these investments in the right proportions. All you have to do is pick the fund that matches your retirement age. For example, if you're 30 years old today and you plan to retire at 65, you would choose a Target Retirement 2055 fund, meaning this fund includes the right mix of stocks and bonds for someone your age, specifically for a person planning to retire in 2025. Target date funds start out with a heavy stock allocation when you're younger. But then, as you get closer to retirement, as 2055 approaches, the fund automatically starts shifting more of your money into bonds, creating more stability and helping you prepare for a secure retirement. Target date funds are the ultimate set-it-and-forget-it investment. So, if you're a little lazy but you still want to do something smart with your Roth IRA contributions and make sure your money grows, they're a really solid option to consider. Personally, I don't like target date funds because they're not customizable. For example, if you want to take on more risk and allocate more of your portfolio to stocks than what's considered normal for your age, you can't do that with a target date fund. They also tend not to include rates, so if you want more exposure to real estate, you won't get that with a target date fund either. That being said, if you want to learn more about target date funds, check out this video on my channel right here. Now, you can see how investing in your Roth IRA is just like planting a garden. And the key is, you want your portfolio to be diversified. You want it to have different types of assets. You want to have your strong, stable trees. You want to have your bushes and flowers. And then the key is, you also want to leave it alone. You want to water it. You want to check on it. But you don't want to rip up the plants, sell off investments, and interfere too much. Because 10 or 20 years from now, you'll be amazed at how much it has grown. Your future self will thank you, especially because you'll be able to withdraw all of this money tax-free. Now, don't forget, you have until April 15th each year to contribute for the previous tax year. As of now, you can put in up to $7,000 per year. So once you put the money in, make sure to plant your seeds, because your future self will thank you. If you enjoyed this video and you want to learn more, make sure to check out some of my other investing videos right here, and I'll see you in the next video. Bye!